Thanks, Amanda. And it's my honor to welcome all of you to the Rabobank Leadership Forum. This is the 5th year we're organizing this event, and I'm pleased to say that we have record attendance this year for our Leadership Forum. We have a number of very important people in the room today. We have clients and colleagues from all over the world. We have Rabobank staff from North America. We have counterparts, we have partners, but above all, we have friends and successful leaders from successful companies. A very warm welcome to all of you. So let me first start with our clients. On behalf of everyone at Rabobank, I'd like to thank you for giving us your business, for giving us the opportunity to advise you, to transact with you and for you. But as I was telling my team, the most valuable thing you can give us is your time. So thank you for that today. As you just heard from Amanda, I'm going to kick off a series of keynotes, panel discussions, recognitions, displays, networking opportunities that I hope will be worthy of your time over the next 2 days. So let's get started. I don't know if you're aware of this graph. It comes from a new tool that Google has launched called the Ngram. It's not so new, but it's picking up usage more recently. And what the Ngram does, it plots the frequency with which a particular word occurs in printed books all throughout history. So this particular Ngram is about the theme that we have for the day today, innovation. And as you can see, of course, in the recent times, that the prevalence of that phrase has really taken off. But if you look at the history of it, it started getting prevalence in the 1600s, had a peak at around 1800, which was around the time of the Industrial Revolution. That was to be expected. But I was a bit curious about this first peak that you see around, I think it's around the 1640s. So when I dug deeper into it, this particular gentleman shows up. And he is not a scientist or an explorer, as you would have expected for an innovator around that time. He was a priest. And the reason he shows up here is because he wrote a number of pamphlets, he wrote a couple of books, and a number of letters to King Charles at the time, railing against innovation that was coming in from Rome and from the Vatican. In fact, in doing so, he ended up offending the powerful Archbishop of Canterbury, and he was in turn accused of being an innovator. He was imprisoned, and his ears were cut off. And not only that, his accuser, William Laud, the Archbishop of Canterbury, a few years later was found to have been the actual innovator, that he was covertly bringing in Roman Catholic practices into England. And he was imprisoned in 1640, and in 1645 he was executed. So that was the fate of the first innovators, ears being cut off and execution. So I think there's a bit of a heretic in every innovator. I'm sure that many of you that are involved in innovation initiatives in your organizations feel the insecurity and the risk that comes with it. So let me ask, how many of you are with organizations that have either a chief innovation officer or an innovation initiative or innovation teams that are active? You have a show of hands? At least everyone at Rabobank should put up their hands. And this is a fact that I think innovation, as this graph shows, is in vogue today. And so as we started preparing for this event, we started to look for what corporations are doing in innovation throughout this year. And to our surprise, what we found was not so much about corporations innovating, but it was more about corporate greed. It was about tax evasion. It was about activist investors and vulture investing. And this was the view in the popular press, but when we scanned the more informed business press, the story was no better. It was about short-termism. I think that's the theme that you hear a lot in business press, even these days. And it's part of the political dialogue as well. So what's behind all of this? And just to put this public perception and the public views that are coming out into perspective, let's take a look at a very successful corporation. This particular corporation pioneered 2 new markets. It had a very asset-light operating model with a 49% profit margin on average. It was one of the pioneers of selling via social network and very quickly expanded its sales in this particular product that it sort of delivered through the social network 25 times. Had an enormously successful CEO who became one of the wealthiest people, not only in his country, but in the world. And if I show you the stock price chart of this company, maybe the stock price chart of this company looked like this. And I think I've revealed what the company was, but if you think about it, this was not a company, this was not a current unicorn. This was the East India Company that 300, 400 years ago was doing things that are very similar to what corporations are doing today. And not unsurprisingly, they had exactly the same press and public response as corporations are having today. The portrait over there was, that's Robert Clive. He was the successful CEO that I referred to. He became one of the wealthiest people in England, but he was accused, not only was accused, he actually indulged in insider trading. He was accused of buying influence. The company was selling opium through the opium dens in China. That was a social network that they employed, and they grew those sales from almost nothing to about 14 million Chinese using opium every day. And they did so by sourcing opium from India and not owning any land. They outsourced it completely. And really made it a success. And they sold the opium in return for tea, for which they got tax exemption from the crown. And they were selling that tea here in the US. And it was, in fact, their tea that was dumped into the Boston Harbor in December 1776. So corporations have been doing things that somehow the public feels is away from the kind of social responsibility that they expect. And then more recently, The Economist had an article which basically said, is the corporation even relevant now these days, given the fact that they're not functioning as responsible social citizens? And of course, this question has been asked before. In fact, an economist, Ronald Coase, got a Nobel Prize for his research on this topic not too long ago. The paper he wrote was in 1937, and his research concluded that the function of a corporation is to reduce transaction costs. That's what they're good at, and that's why they exist. Our view is a bit different. Our view is that corporations are very good at taking innovations to the public. And they do so because they're able to form capital, because they're able to organize themselves and plan for the long term, beyond the lifespan of an individual or even generations. And they are able to then, as I said, form capital, deploy that capital, organize people, and really provide incentives so that they are creative and they take innovations and make them available efficiently and affordably to the public. So this is our view, that corporations are key to delivering innovation to humankind. So they do have a social function. And in fact, historically, they have performed admirably at this social function. If you look at some of the examples, this is one of the early automobiles. This was developed for the French army. It was a cannon carrier. But it was not until the likes of Ford, Carl Benz, and later on General Motors, Chrysler, Volkswagen, took that idea and really organized their whole mechanism of production lines, distribution capabilities, that we now have personal transportation available all across the world. Looking at another example, ARPANET. This was a network, again, developed in a defense lab. It got started, it got some traction in universities, but it was not until companies like Netscape, AOL, AT&T, Cisco developed and organized around this particular network products and services that created the real internet that we know today, where we have Google, Facebook, Amazon, Twitter, Apple available everywhere, every corner of the earth that you go to. So it's not only in these sectors, but in the sectors that are represented in this room. Let's take a look at agribusiness. So back in the late 1900s, early 20th century, late 1800s and early 20th century, the advancements came along. There was chemical fertilizers and farm machinery. Those were the two innovations. And it was companies, there were many companies that were active in taking those innovations and both sourcing agri-products, and increasing the productivity of farms, and then taking those products to the public and making food available to the world. And some of these companies are represented in the room today. We have John Deere, AGCO, Dow, Cargill. And that resulted in the Green Revolution. Moving on to consumer food products, this is a picture of Louis Pasteur. Of course, he invented the process of pasteurization that increased the shelf life of milk. And that led to a number of companies, including cooperatives, producing milk products so that milk protein is now available widely as nutrition across the world in packaged milk products. So clearly, you look at any industry, corporations have done a great job at taking innovations that may or may not have originated within a company, may have been done in defense forces or labs, but they are the ones that are responsible for really making it available, accessible, and usable to the vast majority and the society. So they do serve a very useful human function. Now, how do we then put put into perspective the current views that we are seeing in the press? The fact that maybe they're not doing that function so well. So we tried to use our Rabobank corporate finance model to see how corporations really take innovations and make it available to the public. And as you all know, what corporations do is they access capital, or they form capital. They go to the capital markets, they raise capital, or they are part of an organization that has contributions to capital. They have a business plan. Entrepreneurs or management comes up with a business plan that determines their weighted average cost of capital. They then deploy that capital, make investments, and produce returns that give them cash flows that they either distribute back to their shareholders and stakeholders, or a portion of it they reinvest in the business. So either through the capital markets, those cash flows go back into businesses, or through their own balance sheet. And this is the way corporations create and disseminate innovation. And the key part of this model that is relevant for innovation is investments. And that's where innovation is taken from lab to the public. So again, going back to the public perception, maybe corporations were doing a good job of it, as we saw maybe in the late 18th century, early 20th century, but are they doing so much of a good job about making the right investments today? Is the press right? And usually the press is right. So let's take a look at the numbers to see what the story is. So if you first take a look at national income accounts, you look at how investment has performed relative to GDP. You go back to the 1990s, it has moved around a bit, but it is still within that band of 12 to 15%. There was a little bit of a dip during the financial crisis, but it is coming back up, and it's kind of where it has been historically. So if corporations were doing a good job of investing back in 1990, they're doing a no worse job now. So I think that part of the story looks good. But I think where the press is getting their stories is from looking at S&P 500. And if you look at this particular chart, where this is the ratio of investment to EBITDA in S&P 500 companies over the same period of time, here you can see there's a clear negative trend. You start in 1990, if you include M&A in the numbers, it starts at around, I would say, close to 60%, comes down to about 50%. And if you exclude M&A, it goes from about 55 to 45%. So there is a downward trend. And so maybe on a relative basis, they are really skimping on investments. So let's dig deeper into this, and let's look at the last 5 years. And the way I like to look at it is to look at sources and uses of cash. So on average, in these last 5 years, S&P 500 companies, they started off with about $19 of cash. They produced cash flows from operations of the remaining $81. And then they deployed it. They invested and distributed some. That was about $62. There were some other elements in there about paying down debt and some other accounting adjustments that come in. And then they ended up with some cash. So they did have, if you look at these numbers, the one thing that is clear is that corporations were not capital constrained. They had a lot of cash. They produced more cash flow. They were able to make investments. They were able to make distributions, and they ended up with some cash. So and if you actually look at the opening and closing cash, what is very surprising is that those two bars look about the same. In fact, they're almost exactly the same. So for the S&P 500, companies, again, on average, in the last 5 years, started with $19, ended with $19 of cash. And that says something about the fear of activist investors, that cash hoard hasn't gone up. But then if you look at our sectors that are represented in the room today, agribusiness, consumer food, and energy, the trend is the same. The numbers are a little different. They had progressively lower amounts of starting cash, but they had the same investment opportunities, and they ended up with about the same cash that they started with. So what's the story here? It does seem like that they had investment opportunities, and they did investments and distributions. They were not hoarding cash, at least, from these numbers. So we decided to take a magnifying glass and take a look at that investment and distribution column that we have relative to the cash flow from operations of the $81 that they started off with. So if we break down that investments and distributions, investments are about $35, and distribution is about, I think, $26 or $27. Now, if you look at this picture, and actually Citibank has come out with a research report only last week that takes a look at this and says, well, people are wrong. In fact, corporations are investing enough. In fact, as long as they're investing more than what they're distributing to shareholders, it's all fine. And that's where they stopped. We decided to take a look at that column of investments and break down that $35. And it turns out that of that $35, 19 is just replacement investment. So it's maintenance investment. And the remaining portion, which is about 16, is the actual what you can call growth investments. So this is growth investments. It has some M&A into it as well. And now if you stack it up, the picture looks slightly different. So the growth investment part, I think that's the one you would want to associate with investing for innovation, is a little over half of what they distributed to shareholders. And then if you look at, this is S&P 500, if you look at our industries, it's agribusiness, consumer food, retail, energy, the trend, although the numbers are slightly different, at least for agribusiness and food and consumer food products, it is about the same story, that corporations have been distributing more than what they were investing in terms of their cash flows for growth investments. For energy, the picture is slightly different. We'll come back to that. So we said, OK, let's throw away our magnifying glass, and let's bring out a microscope and look at that light blue bar there of growth investments. Because if you remember, we said that a good portion of that is actually M&A investments. And you would expect that when companies are acquiring smaller companies, they are investing in innovation. They're acquiring intellectual property. They're acquiring innovation. They're acquiring talent that will lead to innovation. But the trend over the last 5 years has been slightly different. So this is a chart of the number of deals that had an aggregate value of over $10 billion over the last 5 years, and the frequency and the number of those deals in those 5 years. So if you can see that those very, very large deals, 10 billion is a pretty big number. Those big deals, they were about 11 a year in 2009, and they have now risen to about 40 for this year to date. And the aggregate value year to date of such deals is about $1 trillion. So that's a pretty big number. That's a part of that blue bar that we talked about. And you can say that while small M&A may be about innovation, these big deals cannot be. They are about buying market share. They're about buying footprint. So clearly, the story that we saw in the national income accounts, where things seem to be stable and seem like corporations are investing at least at a stable level, things do not look as pretty as we look at the actual underlying cash flows and how they break down. But I think then the question may come up, OK, that may be the case, but what's wrong with it? If corporations are indeed underinvesting, it should show up in their results, in their operating results. But when we look at the profitability numbers, while you may say that they're underinvesting over those 5 years, their profitability, the return on invested capital, has been quite good. It has steadily been above what we, a weighted average cost of capital. We use some assumptions here about the level of debt. We used about 70 to 30 debt to equity ratio. But these are pretty good numbers in a low interest rate environment. 7.7% is a very, very good number on average. So there were many companies that were doing much better than this. So you would say that if your incremental return on every dollar invested is so good, maybe that was not the case in the 1920s. But if that incremental return is so good, what's wrong with the level of investment that is prevailing today? So I think then the question becomes, is underinvestment a problem really? And our view is, and coming back to the topic of the day today, innovation is a continuum from incremental changes to really disruptive innovation. And what companies have been doing more recently is on the left-hand side of that spectrum. They are dealing with incremental changes. They're investing in efficiencies, and they're doing very well. And that incremental return has been very good for them and for their boards and for their shareholders and for the markets. But where we believe they may not be doing enough, and usually the press is right. I think we talk about the wisdom of the crowds. So if you're hearing so much about short-termism, there must be some truth to it. So, and the numbers are also right, but they're about a snapshot. I think what we believe is that companies are investing more towards the left-hand side of the spectrum, not towards the right-hand side, which is disruptive change. So they're not investing enough to be able to either deal with disruptive change or to really create disruptive change. And we go back to our corporate finance model here, where we said companies are good at forming capital, deploying that capital, producing cash flows, then returning that cash either to investors or redeploying it in their business. What is needed is to really look at that investment and make a big portion of that investment go towards innovation. And while doing that, looking at the long term, so looking at sustainability. And if you have those two things in mind, innovation and sustainability, then if you can execute well, that's what creates competitive advantage, the ability to deal with or deliver disruptive innovations. And so as Rabobank, we would like to recognize companies that are setting a good example in innovation, in sustainability, and also providing leadership as far as creating competitive advantage is concerned. So what we have done is we've instituted, as you all know, we've instituted the Rabo. We have instituted the awards to recognize companies that are doing well for these characteristics. And you will see these awards being handed out later on in the morning today. What we will also have in the morning is we'll have experts talking about what are the hallmarks of leaders in these companies that allows them to create disruptive innovation and to deal with disruptive innovation. And we have Hal Gregerson from MIT to talk to us about that. And at the end of the day, so we'll move to the other coast. We have Jeremy Bailenson from Stanford talking about one of the innovations that you will see a lot of later on in the coming years, and that's virtual reality. So those will be the bookends of the day. We will have the awards later on in the morning. And then in between, we will have panel discussions. So to warm you up a little bit for those panel discussions, let's talk about some of the topics of the panel. I mentioned that we will go back to the energy sector. And that's one sector where the level of investment, any which way you look at it, has been quite substantial. This is a picture of a spindle top. Again, the same story as the agribusiness and food product sector. A lot of innovations happened at the turn of the century, from 19th to 20th century. It was for the energy industry, it was about geophysics and drilling technology. And there were a number of companies that came around to drill, to refine, and then to market and distribute energy products, hydrocarbon products, to all corners of the world, and creating a real growth engine through the two wars during the 20th century. But what we did see was that towards the end of the 20th century, people were talking about peak oil, the fact that oil production will decrease starting in about 2000s. And the prediction was that by about this time, by 2015, oil prices will be in the range of $400 to $500. But clearly that did not turn out to be the case, and that was because the industry did come up with a way to deal with that disruption, and that happened here in the US in the form of shale and fracking. And that happened, I think that you see that the third logo out there, Mitchell Energy. George Mitchell was a true pioneer. He did not give up. He created a culture in his company that allowed for experimentation. And ultimately, they came up with a technique that really revolutionized US energy industry. And US went from being energy dependent on the Middle East to moving towards energy independence. And it has an impact on a lot of things, on geopolitics and a number of industries that go beyond oil and gas. But that doesn't, if you look at the US story, yes, that may be fine, but you say that, okay, the US increased its production, but there are some disruptions, and Iraq did not come back on board. Libya was disrupted. So if you look at the overall global oil supply, it went up from about 90 million barrels per day to about 94 million barrels per day. That doesn't seem like that much. If you think about it, there are the increase from 90 to 94 million barrels. There are about 2/3 of world oil production is on the sea on any given day. So that's about 60 million barrels. And so that 4% increase that we talked about is about, I would say, this is right, 2.5 million barrels. That's just about the size of an oil container, of a VLCC container. So it was one ship per day extra in terms of oil supply. And you look at the price graph, and the difference is much more dramatic here. If you look at the oil supply went up only 4%, but in the last 12 months, the oil price decrease is 50%. So that real little bit increase of one extra ship a day led to a 50% reduction in oil prices. Why and how did that happen? The reason it happened is that increase in supply came around the time when this particular country was going through a slowdown. And the chart that you see there, these are all oil tankers in the South China Sea. There is a glut of oil in China. Their oil inventories are at an all-time high. And that's not only the story in China. That's the same story here in the Gulf Coast, same story in Cushing. All storage facilities are full. So that is what is creating this downward spiral in oil prices. And if you take a walk around the world at other producing locations, Saudi Arabia, you may think, and they've made some statements recently, that they will work with OPEC to stabilize oil supply. I can tell you, you can forget about that. Saudi Arabia has tried a lot of things to diversify away from oil. Nothing has worked for them. In fact, they are preparing to issue bonds. They are in it for the long term. This is a long-term battle. They want to defeat US shale. They want to make sure that Iran and Russia do not dent their competitive advantage. They produce oil at about $5 a barrel. They can keep pumping and make sure they can drive others that are much higher cost producers out of the market. Then if you look at Russia, if you look at the numbers from Lukoil and Rosneft, and some of them may be in the room today, their cost of production is about $20 a barrel. And as long as they're not investing in innovation, but as long as they can keep doing their maintenance investment, they will keep pumping because Russia needs that revenue, that oil revenue. They are not going to reduce that production. If you talk about Iran, if the sanctions are lifted, they are ready to put in about $1 million barrel a day. They're ready for it. So the only place where the reduction is happening is, again, it's here because market forces prevail. We have entrepreneurs. So the rig count has gone down substantially. But if you think some of these shale entrepreneurs, these companies, are packing up, folding their bags, and going home, that's not the case. Yes, the oil rig count has gone down, but at the same time, they're also investing in innovation, in efficiencies. They're using driverless trucks. They're using much more precise drilling techniques, measurement techniques. So they will not disappear. Yes, they will become more efficient. Yes, they will maybe scale down a bit, but they will not really disappear. And if we talk about Mitchell Energy, they were in gas. So if you look at the gas oil equivalence, it's about 6.3 times. So if you look at gas prices today, yesterday at NYMEX, they were about $2.1. So that times 6.3 is about $20. So that's the hydrocarbon equivalence of natural gas to oil. So it's a price of about $20. So as long as there's gas, USA, Canada, Mexico, that downward pressure on oil prices, pulling it down from $50, is going to be much higher, in our view, than the upward pressure towards 100 because of capacity reductions and whatever we can anticipate the OPEC to be doing. Of course, they may surprise us, But if you're interested in that topic, that's our first panel discussion on resources, because this will have an impact not just on the oil and gas industry. It'll have an impact on renewables. It'll have an impact on all other resources. And don't forget, we have this week talks going on in Paris, and the governments may decide something that will disrupt what the resources picture looks like. So any interest in that topic, please attend the panel discussion on resources. Now moving on to consumer food products. We have our favorite moderator, David Bell, here, talk to us about it. But again, going back to history, the innovation in that industry was about shelf life, whether it's pasteurization, packaging, the tin can. Those were the seminal innovations in the industry, and a lot of companies came around and created a whole machinery of marketing and distribution to take those now longer shelf life food products to dinner tables. And some of the companies that you see here on the left-hand side, the 10 companies, they were the most dominant towards the turn of the century. But look at what has happened to these companies in the last 5 years. According to our calculations, these 10 companies together have lost $22 billion in sales in the last 5 years. And where have those sales gone? They've gone to companies that you may not have heard of. These are the companies that cater to Hipsterville in Brooklyn. And I think what many people say is that these are the companies that there's a change. There's a generational change. We have the new millennial consumer. This millennial consumer wants quality. They want to make healthy choices. They want information. But I think my question is, I think we're mixing things up here a bit. If you were to replace, which consumer will not want healthy choices? Which consumer will not want better information? Which consumer will not want transparency and trust? I think if you were to replace the whole millennial cohort today with, let's say, baby boomers, I think they will behave the same way, because information has progressed. They have more knowledge than was available in the 1950s and 60s. And so they expect something better from what is available. And as long as there's someone who's prepared to give them that something better, that's something different than what is available as a norm, people will buy it. And then you will see that kind of revenue reduction if there are companies that are wedded to their assets and are not able and not flexible enough to cater to that new demand. So if you're interested, in any case, there's disruption going on. And if you're interested in that topic as to how consumer disruption will be handled by food companies, please join the consumer panel later on today. Moving on to agribusiness, again, it's a very similar story. Innovations happened, turn of the 19th to 20th century. They were about chemistry and they were about machinery. It was about fertilizers, it was about farm equipment, and then along with some improvements in seeds and irrigation, it created the Green Revolution in the 60s, and since then there have been incremental improvements. But what this industry is facing is also a disruption. What the increase in productivity that is required is about 1.2%, and whereas what the actual that we're experiencing, the trend that we're experiencing today, is 0.75%. So that will not be enough, and we've talked about this. You've heard Rabobank and others FAO talk about this, is whatever innovations we had available to us and our companies worked very well at, they have been fine for us to serve the needs of the 7 billion that we have on Earth today. But it will be almost impossible to do the same thing and be able to feed the next 2 billion that we expect over the next 30 years. So the story in agribusiness, as you may have heard, is going to be less about chemistry and machinery. It's going to be more about biology and data. And agribusiness has got big expectations from big data. If you have interest in that topic, please join. That's our third and last panel later on in the afternoon today. So I want to just wrap up a little bit and warm you up for some of those panel discussions so that you can ask some tricky questions. So I'd like to give you some case studies from companies that have dealt with disruption. So the first one, this is the winner of the 2009 National Medal of Technology and Innovation. This gentleman's name is Steve Sasson. He invented the first digital camera in 1975. And if you can guess the company that he used to work for, it was Kodak. And that's his company. That's the company that missed the digital revolution and missed the market shift. And look at what happened to them. They continue to believe that they are a film company. They had looked at what happened to Polaroid. In fact, they had the opportunity to acquire Polaroid back in the 70s. And they passed on it, and they felt very good about it. They felt, all these technologies of instant imaging, whether it's Polaroid or digital, they felt they're always going to be niche in terms of demand. They felt very good about being a film company. They had great margins. And starting in the early 2000s, their numbers began to tank, and they folded up. They filed for bankruptcy in 2012. Another example for a company that actually got the shift, but could not execute well. And this company was Firestone. Firestone was actually the company that provided tires for Ford's Model T. And they were also, in the 1960s and early 70s, one of the most successful Fortune 500 corporations by any measure. They were cited as an example of the kind of company that everyone should like to become. They actually saw this shift coming in the tire technology for radial tires. They were fully on board with the fact that radial is a much better technology, it's much safer for cars. The duration, the life of radial tires was double that of the existing technology. So they started investing in it, but they did it in a half-hearted way. And the reason was they had this internal hurdle rate of return of about 10% or so. And this new technology, and as you can imagine, if it's going to be twice as long-lived as their existing technology, their demand is going to have. And none of their models could predict a good performance as they were budgeting for their pre-tax income. They could not make it work to invest in this new technology that was going to be less profitable than what they had deployed. So they could not work fast enough. Their clients moved faster than them, and their results started to tank, this time in 1975, and by 1979, they had to sell off. So two iconic companies, Kodak, Firestone, iconic American corporations. What a sad end. So now let's look at another icon that actually did well with dealing with disruption, got it right. This is a company that made cash registers in 1930, typewriters in 1955, was the leader in mainframe computers in 1965, leader in semiconductors in 1975, 1980 came up with the PC and created a market around it, 1990 mobile laptops, 2005, IT consulting. And I'm sure you've guessed this company by now. This is IBM. So somehow they seem to have managed to read the trends in the IT and technology sector and have been able to make these multiple shifts so many times. And we will hear from, I hope we'll hear a little bit from Hal as to how they did it and what the hallmarks of a company like this are. And but one of the things that was very clear was it's not that they did not have any doubts. In fact, Tom Watson Sr. is famous for saying, I think it was 1945 when digital computers were first being talked about. He said that the global market for computers is 5 computers. But that did not stop his company. That he had a culture. People, project teams kept working on it, and by 1965, they turned it into a business and became a leader in that business. And they've done it many times, and they're doing it now, moving from IT consulting to more on cloud and predictive analytics. And they do it without fear of short term. I think that's the other hallmark. If you look at their revenues, they've had declining revenues for a number of quarters now, but they are more focused in the future. They are able to explain it to shareholders, at least to some shareholders. We've just seen more recently that Warren Buffett has bought into IBM, has increased his stake in it. So clearly, their message must be something that if a value investor like Warren Buffett can understand, they must be doing the right thing. So I think that's, from our point of view, if you look at the model that we had earlier, that maybe underinvestment is not a problem because companies seem to be doing well. But smart investment, as we talked about earlier, with innovation, with focus on sustainability, is definitely the answer. Before I end and hand over to Hal, I wanted to do a quiz to see if you can guess this particular. We started off in the 1600s, and I'd like to finish in the present time. So this is not going to be a trick question like East India Company. This is something that is contemporary. So this particular organization was a one-time high flyer. It was like IBM, like Kodak, like Firestone, like the East India Company. It's a pioneer. But More recently, around between 98 and 2004, they had gone through a period of underinvestment. They had the lowest revenue in their league, and they were one of the worst performers in this time period, 1998 to 2004. There were some regulatory changes in 2005, and the company itself had some management changes shortly after that. Their competitors invested to maintain the status quo, so they invested in what's called core competitiveness, and for a while they did very well. But our particular company took some bold steps, made what we were calling smart investments, went against the grain, and ended up coming back and has occupied the top spot in league tables for the three of the last 6 years. So I don't know if anyone has any guesses. I don't know if Citibank is a guess from Dominic Ratu here. So let's maybe an audio clue will help. Can we have the audio clue, please? Any guesses now? Chicago Blackhawks. That's the right guess. So Chicago Blackhawks, they were one of the first six. They were the pioneers. They were the original 6 teams. But they were called by ESPN in 2004. They were called the worst team in any professional league, not just in hockey. They were doing so bad. But what they did after the management came in 07 and with the new coach Joel Quenneville was that they went against the grain. Instead of, and like in hockey, and our friends from Canada will understand this, most of the teams invested in size and toughness because that's what hockey is about. But Chicago Blackhawks, maybe out of necessity because they could not source those bulky shot blocking and pinch-hitting defensemen, they went for speed and skill. They, in fact, ended up having the lowest body weight, average body weight of all teams in the league, one of the lowest. And that's one of the signs of weakness. But they had the lowest body weight. They had the lowest number of penalty minutes of any team. Again, penalties, as you know, are very strategic in hockey. But what they did have, they had the highest possession rate, and they had the highest speed. And they ended up turning the team around, and not only turning the team around and winning 3 Stanley Cups in 3 of the last 6 years, as I said, but also they have wonderful performance as far as social media is concerned. They're one of the most successful. They have the best, highest followers on social media. Their stadium attendance is the best, and they're one of the most profitable league and valuable teams in the league today. So with that, I will hand over to Hal to talk about hallmarks of some of these companies and leaders that manage to deal with disruptive change and create disruptive change.